When we look at Europe, we want to talk about the ECB first, because for those that have been watching us, our call was that the ECB was going to be more aggressive than estimates. And we were right, obviously only by 25 basis points. But again, the market was expecting 0.25% or an increase of 25 basis points. And we said that we thought it was going to be something closer to 50 to 75 basis points, just given the issues that they're facing. And that's what we got. We got an increase of 50. So the lower end, the main refinancing rate, it came in at 50 bips. Marginal lending facility came in at 75 basis points. So again, you got that 50 bip increase with the deposit facility rate now flat. So it's just funny to think that things were still negative as of June and July of 2022, given where we sit in the market. Eurozone manufacturing has gone negative, so it was expected to be at 51, came in at 49.6. Services was expected at 52, eked out positive to be 50.6. We actually think that is now firmly negative. And then the Eurozone comp is coming in at 49.4. So again, we've now hit contraction in July. So I think this is a better read in terms of where things are right now and going forward, especially when you start looking at the economic confidence was expected at 102, came in at 99. Industrial confidence came in at 3.5, almost 2 points off of expectations. Services and then consumer confidence remaining slow. So again, you're seeing the pressure, you're seeing the problems as the money supply is slowing, but still, again, in an expansionary place. But when you start looking at the inflation expectations, inflation and excluding energy, you still have this view of a very steep drop. And if we've learned anything, it's going to be anything but a steep drop, especially when you consider that they're already shutting down, or I should say, starting to ration natural gas due to the shortages that are coming from Russia. This is causing things to slow down, which is going to increase price because you're, again, taking down supply. And that's what we've talked about on the EIA show, on other shows, other econ shows. There's that supply-demand metric where, yes, demand has come down, but supply hasn't gone up. It's either stayed flat or actually fallen. So that means that in order to get to a balanced approach or balanced market, you need demand to fall further. And as demand falls further, that just creates more and more stress on the underlying economy. And that's why the longer term inflation expectations continue to shift higher. As we've seen time and time again, they continue to underestimate where inflation is going, which is why when you look at the ECB expectations for real GDP growth, they still have everything positive. And I would have to argue with that. I think very positive view, or very. I don't know. I don't think it's based in reality, but that's just my opinion. And then when you look at those staff projections on inflation, they're calling for another flatlining, and you can see that they've learned a bit in the sense of they're now expecting not this huge drop off, but more of a stagflationary component, though unfortunately I do see several more months of increases prior to we getting any type of flatlining, though this will help. But just look at how far behind they are from people or central banks that I would say are still far behind, which is especially the Fed and the EC and the BOE. Even though the BOE and BOC got aggressive a bit sooner, you could see that the ECB is still so far behind, which is again why we think there's going to be more inflationary pressure in this area still to come. And this is when we look at what the market is pricing. As we go into the September meeting, there's another 50 basis point increase. I think that's likely. Again, I called BS when Draghi, I'm sorry, not Draghi, when Lagarde said that they weren't going to be that aggressive. I think they're going to have to be aggressive. I do think that we're going to get over 1% as we get into the end of the year, and with more raising hikes coming as we head into 2023. And the problem is, though, the economy is already slowing. So you were already negative, and even at a negative number in terms of the ECB rates, you still couldn't generate growth. So just consider if it was a normal market, how bad things would be and how they're going to have to get worse in order for them to get any meaningful adjustment in flows. but the composite bank funding rates continue to move up, and that's what we've been saying is even if the ECB doesn't move, rates are going to move without them. And we've already seen that with just based on the spreads in Italy. Now you're seeing it in France. The spreads are going up because people are pricing this in based on, look, the economy is struggling, but even as the economy struggles, inflation's still parabolic, and that's not changing anytime soon. So the Eurozone gap between consumer and business confidence, consumer confidence continuing to move lower. But again, there's that gap coming down. But as the consumer slows, that's going to bring things lower. Negotiated wages have gone up, but it's still well below where inflation is. So real wages are still getting absolutely crushed, which is going to slow down buying, which again is going to bring business confidence down, slow spending, on top of the fact that exports, as we discussed in segment 1, are going through a floor, which is why Eurozone Consumer Confidence Index was expected at negative 24.9, came at negative 27, the lowest it's ever been going back to 2001. Euro area household deleveraging is now over. People are forced to again start going back to either credit and or some sort of loans just to try to maintain their activity, with the euro area driving that. Eurozone consumer expectations have been falling, and again, that's going to continue to fall, which should start to flatline inflation or CPI. But the problem is, again, that supply problem. You have a lot of outside influences. Now, this is taking away the slow ECB, which is going to be a tailwind for inflation, but you also have those supply disruptions, which have not improved and only gotten worse in the area, which is where you look at Eurozone manufacturing PMI, again, going negative. You have France was expected at 51, came in at 49.6. So a big about face. German consumer confidence expected at 28.9, came in at 30.6. French consumer confidence expected at 80, came in at 80, still the lowest it's been since 2013 and 2008. So but Germany's the big driver. It's the largest economy in the EU, and they are nosediving, which will drive down or bring down everyone else as well. Eurozone composite PMI expected 51, came in at 49.4, but look at new orders. New orders are even lower than the composite, which again is showing the trend, showing where we're headed and the pressure that this is going to get into. With German GDP, obviously, again, it doesn't have to go perfectly with the IFO expectations, which we'll talk about, but you can see that the trend is very real, and that is just showing why we believe that we're already in that recession. Business climate, when you look at the business climate currently, it's at 90, it's at 89. Assessment of business situation, again, moving lower, with business expectations just falling through a floor. And the same can be said on manufacturing, services, trade, construction. There is literally nothing that has a positive bent to it, which is why when you look at just the confidence plummeting again, you have to look at just the speed in which it's falling, how quickly things are coming in. And it happened in 2008, 2009. It didn't really get as bad in 2011, but then we're already talking or getting close to where we saw things at the peak of COVID, with business sentiment again falling. So global recession is coming. There was a recession forecast for the Eurozone since March, and the recent data flow is increasingly pointing to a severe recession that will engulf Germany. If it engulfs Germany, it's going to engulf the rest of it. The forward-looking expectations component in the German IFO survey is almost as bad as 2008, and I think that's a huge component when you look at just how deep is this going to get, and what can the ECB do given it's already had such an easy monetary policy. There was no tightening, so the law of diminishing returns is fighting against them in a huge way, which I think that needs to be appreciated. German new orders are at 40. So it isn't like it's just bumping along the bottom. You are firmly in contraction, which is going to continue to be a problem. And even with services expected at 51.4, coming in at 49.2. So again, contraction across the board. Germany manufacturing expected 50.7, came in at 49.2. German manufacturing output clearly in a contractionary standpoint. And again, these are the key pieces that we've talked about that we thought manufacturing was going to hold in a little bit better. We've been talking about services nosediving, but having both of them happen at the same time is going to become and create a bigger issue when you look at just the severity of the recession. German PMI inventory, orders minus inventories. Italy, same thing. Again, all of this indicative of more pressure ahead with business pessimism, expectations getting worse, current assessment, again, flatlining, but still moving down in a big way. North Sea container ship traffic is still elevated, as is just showing how there's still those problems when you're considering the underlying supply chain, and again, the inflationary pressure that this provides, given the disruptions that remain on the logistical front, keeping things elevated. Now, Italy is in its third debt trap since 1992. Which is why when you talk about the fragmentation clause that the ECB is trying to push, this is what they're looking at when they're discussing the fragmentation clause. So now when we look at consumer price inflation year on year, it's just going parabolic. Central bank policy is trying to move up, but Slovakia has been the lone standout of trying to delay the increases, but it's just going to make the pressure all that much worse, with French service PMI eking out some expansion. But as we've been saying, we don't expect that to remain much longer. So again, things have just gone from bad to worse in Europe. We don't see it improving it. We think it shows just how aggressive the recession is going to be. And it's not pointing at anything good in the near term. So that's what we have for you on the European front. The next side, we're going to talk more about not only China, but also Asia and where things are going in the region.